Let's bring Dan Lacalle into the conversation. He is Chief Economist at Recession. Dan, nice to see you this morning. Very big week for central banks here. The markets effectively, I think, on the back of a lot of that softer data now out of the States, looking for 25 basis points out of the Fed, maybe 50 from the BOE and the ECB. Do you have any variance from that? And how do you think these central banks then begin to modify inflation expectations?
Good morning, Jeff. I think that what is most likely is that the changes in this week, that the hikes this week are going to be a non-event. Everybody is expecting the Fed to hike by 25 basis points and the ECB to do it by 50. I think that that is already in consensus. I think that the problem is that investors continue to believe that there's going to be a reduction in rates in the second half of the year. Central banks have been saying over and over again that that is not the case, that inflation remains too high, that core inflation is the problem. We have to remember that we're in the middle of a rally in which core inflation remains extremely elevated, despite the reaction of commodities with a U-turn. So I think that that is what central banks are going to be focusing on. Reminding investors that it's not about reducing rates in the second half of the year, that it's about maintaining the path and then keeping rates at the expected level from then onwards to see if inflation finally does come back, which it isn't in terms of the core goods and services, is it?
So given that's the case here, Dan, do you think the equity markets and the bond markets are still running ahead of where the central banks actually feel interest rates need to be?
I think that bond markets and equity markets have got a little bit too excited about the idea of a change in the central bank rate hike path. And I certainly believe that the European market is not discounting the more aggressive tone of the ECB. So we need to be at least prudent in terms of taking action on duration, on very cyclical stocks, because the earnings season is not helping either. So far, the earnings season in Europe is pretty dire, and I would not be looking at guidance to be any better. In fact, what we are seeing is all over the spectrum, companies being extremely prudent about an outlook that doesn't seem positive, certainly to suggest that the consensus estimates for 2023 and 2024 are acceptable. So I think that we need to be a little bit prudent. I think that it's a good moment, like it was in August, to reduce exposure to the more cyclical stocks, and certainly to rebalance, because Europe has certainly gone way ahead from where it should.
Daniel, can we just explore the ECB playbook to an extent? Because sometimes timing is everything. You know, we've seen a lot of front-loaded action from the Fed at this point, and the ECB much slower on the journey here. If we get a 50 basis point move, could they just really be in territory after this of jaw burning? Will that be enough if the Fed starts to slow its pace of increases?
I don't think it is the case for the ECB. I think that the ECB found way too late that they were running very, very far behind the Fed. I think that they know that they need to catch up. I think that the ECB is very aware of the challenges of inflation in the Eurozone. The latest figure was a small improvement in the energy component that was not even enough to be happy about it, because if you think about what is happening on the energy side, on the commodity side of prices, most of them U-turned completely into the end of the year, yet inflation only marginally reduced. But more importantly, core inflation. core inflation remains extremely elevated, and aggregate demand is not reducing, which is what the European Central Bank knows is the only way that will curb inflation. And the European Central Bank knows something, is that they know that it's much better to take decisive action now than to enter into a decade of stagflation. That is the biggest risk for the Eurozone.
Dan, as you sound suitably downbeat around the prospects for Europe at this stage, and you call US stocks as a better trade, where do you see the upside? Because we've got a lot of technology numbers coming out this week. The short sellers have been taken out on some of their positions because of the momentum trade we've witnessed on technology. How do you see that US market playing out in coming weeks?
I think it's time to reduce exposure to Europe and increase exposure to the United States. First, because the momentum in earnings is much better. If you look at the earnings so far in the S&P 500, most of the companies are giving better sales and better growth than was estimated. Also, in terms of the guidance, it is also much better, but also buybacks. People are forgetting buybacks. On the other hand, in Europe, it is very difficult to see most of the companies that are the largest weights of the stock 600 actually not just beat, but meet the consensus expectations of 2024. So in general, it is a good moment to rebalance, simply for one reason. The positioning of investors is way too downbeat on many of the stocks. And even in the case of tech stocks, earnings have been much better in general than what investors were initially expecting in the United States. However, in the Eurozone, you cannot buy into a multiple expansion theme when the Eurozone is basically just moving from an outlook of recession to an outlook of stagnation, which is not particularly appealing. And certainly there is no buyback to help in the investor process of looking at total shareholder return. So I would be more cautious on Europe, certainly, and more bullish on the US, because right now the positioning of investors in the US looks like it's discounting all the negatives: recession, rate hikes, normalization of the balance sheet of the Fed. However, none of the reality that the outlook for earnings is better. And that is not meaning that it's fantastic, but is much, much better than that of other developed economies and emerging economies.
Dan, can I ask you quickly about gold? If you just take a look at the chart, you can see getting back towards the highest level in about even 5 years, the top end of that trade. It's been a fairly stunning momentum move that we've witnessed in recent weeks. Is there anything left in it?
I think there is still quite some momentum in gold. To start with positioning, now you think of investors globally are extremely underweight gold, because in 2022 it wasn't an asset class that people were excited about. And we have a lot of things working for it. On the one hand, central banks are purchasing more gold to balance their reserves. So the demand from central banks is adding to an already robust demand globally. On top of that, you have a very poor outlook for supply. So it's a very tight market. Additionally, you have a weaker dollar, which certainly helps gold. But I think that on a larger scale and on a more long-term picture, gold is actually providing one of the very few asset classes for investors that is actually decorrelated. Right now, the reason why I'm certainly a little bit cautious about January is because all equity, bonds, cryptocurrencies are moving in unison. Sounds a little bit like August to me, but you need to have some decorrelated assets, and certainly in that environment, both the fundamentals and the momentum elements of gold continue to give it some opportunities for investors.
And Daniel Lacalle, thank you so much for joining us, Chief Economist at Tressis Gestion.